CMHC recently announced a change to qualifying criteria that's going to come in on July the 1st of 2020. And so what will that do for you? How will that affect your qualifying, and who does it apply to? I'm Stephen Cruz, mortgage broker with Paragon Mortgages and mymortgagebroker.com. And what I want to do is review that change and how it could affect you for your future qualifying and what you might want to do now before that change occurs. Let me share my screen and we can review that right away. Okay, so what did CMHC change when they made the announcement on the 4th last week? The main change was that they were reducing the GDS TDH ratio from 39:44 to 35:42. So I've talked in other videos about the GDS and TDS. GDS is the gross debt servicing ratio, which refers to the amount of your payment for the mortgage, which include property taxes, principal and interest, heating your property, 50% of the condo fees. All of that payment cannot exceed 39% of your total gross income on a monthly basis. So they've reduced that 39% down to 35%. And the TDS is the total debt servicing, which means all of your mortgage related costs, which would be, again, principal and interest, taxes, half the condo fees, heating your house, plus any other monthly debt you might have. So loans, credit cards, that sort of thing. And so that cannot exceed 44% of your income or 42 as of July the 1st. So that will reduce your qualifying amount and your purchasing power potentially between now and after July 1st. The other change they made is the minimum beacon score requirement. So they've increased the minimum beacon score from 600 to 680. Now 680 is typically considered a good credit score, and most lenders today will not finance a property where high ratio insured property with a beacon score of less than 620. It's getting quite difficult. So moving up to 680 will take some people out of the market. And if you've had some issues with credit card payments or some other things during this whole COVID situation, then your beacon score may be lower and it may again affect your ability to qualify for a house. So let's look at an example and see what it means to someone who earns $85,000 a year. I thought I'd use that as a generic number. We can certainly look at other numbers. If you wanted to, you can just connect with me. So based upon an annual income of $85,000 with zero debt, before the change, so before July 1st, you could potentially qualify for a purchase of $400,000 with 20% down, minimum 5% down. And after, as of July 1st, you would qualify for $360 purchase price with 5% down, so that would be $18,000. So it would reduce your buying power by about 10%. Okay, so what about the homebuyer incentive? Last September, CMHC announced a homebuyer incentive, or the government did, and they're operating it through CMHC. So the homebuyer incentive was for purchasers, and it was like a shared equity program. And the program had some criteria associated with it. Namely, you had to be a first-time homebuyer, which means you couldn't have owned a home in the last 5 calendar years. The maximum amount you qualify for would be 4 times your annual income. The maximum income you can earn to qualify for this program is $120,000 per year. It's a shared equity program up to 5% or 5% on a resale home. So a home that's listed on MLS, a home that's already been owned before, and they'll provide up to 10% shared equity in a brand new property. So if you're purchasing a new condo or house, then you could actually get 10% from them with a shared equity position. And you must be able to provide the first 5% from your own resources. So let's see how the homebuyer incentive qualifications may or may not have changed with the new change in the criteria. So before, when we calculate this and use those rules, based upon $85,000 a year, just like we did before, the criteria for maximum purchase price would be $360 before the rule change, and after it's the same. So basically, CMHC has effectively brought into alignment their qualifying criteria for the homebuyer incentive as well as this new program. So They may have thought about this in the past and considered doing this in the future. This may just be a convenient time to do it. But that is what they are now looking at, is aligning those two policies to basically come up with the same maximum number. I'm not necessarily offended, or I don't really disagree with them wanting to do this, but it does affect your qualifying, your buying power. And sometimes people make more money than they can confirm on their income tax returns. So sometimes they receive additional funds for whatever reason, but that's not verifiable income, or it's not really used for the purposes of qualifying by a lender. So sometimes people make overtime, for example, and they've only been working for a shorter period of time. Their overtime's been fairly consistent, but we can't use the overtime because they haven't had the job for long enough, or they haven't showed enough time with the overtime to qualify, even though they could easily make those payments. Sometimes, they're not including a spouse in the purchase. Spouse is living there as well, not including their income. With their income, that is allowing them to more than afford the payments. So your buying power is reduced, and there's quite strenuous, stringent requirements on income. So not everyone's income is used exactly the way it should be. So let's look at the three insurers. I did say CMHC announced their change, and Genworth made an announcement today, and they announced that they would not be changing their criteria. So, and Canada Guarantee is the third insurer. So there's three insurers in Canada. When I say three insurers, I mean three default insurers. This is default insurance, which means that you are paying to protect the lender, and in the event that you don't make the mortgage payments. So you're providing the lender with a default insurance. So if you stop making the payments, the lender's covered so that they get that debt wiped off. They don't lose any money. And then CMHC or Genworth or CG are responsible for taking over that property. And so with this program, CMHC has made their change. Genworth has said, no, we're not going to make a change. At least they suggested they have no plans to make a change. And then Canada Guarantee hasn't made an announcement yet. In the past, when CMHC has made changes, Genworth has typically followed some time later. So they've followed 30, 60, 90 days later. So in this case, we may see them change their minds and follow in the future, or this may just be a time when they decide not to. CMHC is government guaranteed. It's a government organization, whereas Genworth and Canada Guarantee are private corporations. So they can make their own decisions based upon what they feel the risk tolerance is. And so we might see a divergence now between the government guarantee and the private corporations. And we may see this as a change in our current environment, where CMHC is trying to get out of doing all of this and allowing private corporations to move forward with it. So this may be the beginning of a change. So let's take a look at some of the costs and why and what will happen. So what does this mean with respect to this change? So first, you may be limiting your options. Because CMHC has made this change to make it more difficult to qualify, now you can only go with Genworth or Canada Guarantee if you wanted to qualify at that old requirement. And some lenders don't allow you to choose. So you go to a lender and they choose, and their system may be designed not to allow the person that is doing the mortgage for you to choose whether or not it's CMHC or Genworth. So they may end up just using CMHC rules and not qualify you for as much. So you are limiting your options. The other thing is there's some downward pressure on values. Because CMHC has done this, it's reducing Canadians' buying power. And so when that happens, when people can't afford to buy something or they can't qualify, then that tends to have a downward pressure on the market. So CMHC's doing this because they see risk, but they're creating more risk by doing it. So I'm not necessarily a fan of what they've decided to do, and I don't necessarily agree that it's what they want for the future, but I do understand why they think there is some risk. The other thing that I must stress is it's really important for you to work with a professional. When you are working with a bank, you don't know if they're qualifying you based upon the criteria for CMHC or others, and they don't know what options that they're giving you. So you want to be working with someone who is sitting on your side of the table. When you work for a lender, when you go in to see a lender at a bank, that person is sitting on the other side of the table. They're sitting representing the bank and the interests of the bank. They're not representing your interests. Whereas when you work with a mortgage broker, the mortgage broker will let you know if they're representing the lender, or if they're the intermediary, or if they're your advocate. And it's important for you to know what position they sit in so that you can listen to and hear their advice from that perspective. Because if they're your advocate, then they should be providing you advice that's in your best interest. If they're an intermediary, then you get to hear the advice on both sides, but you don't necessarily get an opinion from them. So it's really important for you now to work with a professional who is on your side of the table, who's looking out for you. Let me just look at the CMHC insurance premiums. Over the last number of years, they have jacked those premiums huge. So it used to be, many years ago, used to be the 5% down premium was just over 2%. Now it's 4% of the mortgage amount. So on a $360,000 purchase, to kind of go along with the trend, with 5% down, $18,000, that's a net amount of $342,000, and the default insurance premium is $13,680. So they're effectively financing 99% of the purchase price when you put 5% down. However, 4% of that is the default insurance premium. And if we just use a generic interest rate of 2.99%, and there are rates that are lower than that today, but I just wanted to use that as kind of a generic number over the last couple of years, at a $1,600 a month payment, it takes you 17 months to pay back that onerous premium. 17 months to pay back this default insurance premium. So you're getting to the point at which you actually put your down payment down after 17 months, which is a long time. So I'm not necessarily, again, I don't necessarily disagree with what they're doing, but they have jacked costs. They've increased their profitability. Canadians have had substantially lower defaults historically and recently than our brothers down in south of us, but we typically don't default on our mortgages. It's a very, very small amount. And so their profit margins are substantial and getting bigger. They're building up a bigger war chest, and I just don't know if they're really looking out for the best interests of Canadians. So let's look at principal reduction over time. So you purchase, again, $360,000 with 5% down, and then your default insurance premiums, $13,600, mortgage amounts, again, $355,000. So after a year of making payments at $1,681, you've paid down about $10,000 in principal after a year. After two, another $10,000, and 3, 4, 5. So after 5 years, you've actually paid over $50,000 in principal reduction. So you're actually reducing this principal fairly quickly. And so the risk to CMHC over time is diminishing substantially. So $50,000, that's more than 10%. That's almost 15% of the total value is being paid down in principal. So their risk over time is not as big as they're suggesting, because all these other years, people have been doing that. There's one other factor that is important when you consider your mortgage, and that's the payout penalty. In Canada, we have these huge payout penalties that we have to pay, and it depends on whether or not you're with a Big Five bank or if you're with a monoline bank. Big Five banks calculate the discount based upon a posted rate. So they say the posted rate is 494 and you're getting 299 or 249 or whatever it is. And then they compare your interest rate that you have on your mortgage against the discount that was given versus the remaining term. And that is a really onerous calculation. It's ridiculously onerous, in fact. And I think that there should be some advocate somewhere who is fighting for Canadians to stop these banks from charging these ridiculous fees. MonoLine Lenders will compare your penalty based upon the replacement rate that they could get the mortgage for. The whole theory behind penalties is that you've signed a contract and you say, yes, I'm going to stay in this mortgage for 5 years or 7 years or whatever length of time. I'm happy with this. And the banks say, okay, well, you've signed this contract. So if you break your penalty, your mortgage, we have given this money to someone else. An investor has invested the money here. So it's not our money. An investor has brought in the money, and we are guaranteeing this investor a return because you signed a contract. And so if you get out and break the contract, then we have to replace this mortgage that you have with a new one and replenish it so that the investor keeps their return. And so, yeah, that sounds fair. Okay, that sounds fair. However, when you calculate based on a discount and you're not talking about a replacement, a true replacement rate, that's when the onerous mortgage penalty calculation comes into play. And there was a story here with on Toronto CTV, Toronto CBC, there was a woman who was charged a $30,000 penalty by a big bank because they had difficulties during the COVID situation. They sold their house so that they didn't have to make all these payments, and they have a $30,000 penalty. Had they been with a monoline, and I don't know the calculation exactly, but I've done these calculations for many clients, excuse me, and had they been with a monoline, that penalty was probably going to be $2,000 or $3,000. And by the way, monolines, their interest, the money that they lend out comes from many of the big banks. So the big banks invest in the monoline, but they don't charge the ridiculous fees. The big banks charge the ridiculous fees and penalties for their own customers. So the big banks aren't looking out for your best interest. And they've made these calculations, and they know what they're doing. And they know a certain percentage of clients will break the mortgage early, and they are reaping the rewards of that. And so it's really, really important, once again, for you to look at the penalties and who you're working with, and make sure you're working with a professional. So this story, you can search it yourself. And I took out some of the ABC banks. I didn't want to name the bank here, but I did a search for this lender or this penalty calculation by a Toronto woman. And you can read the story all by yourself. I also will put a link in my I'll put a link to the story in the description below. And I also put a link on the calculation for the mortgage penalties. This video was not about mortgage penalties, but I wanted to let you know how the change affects you and your ability to qualify and what it means to you. So if you like the information in my videos, please like and subscribe to my channel. If you have any questions for me, you can reach me at mymortgagebroker.com, go through the contact page, and I would be more than happy to answer your questions. Thank you, and have a great day.